Sit or stand or stand? Yeah, okay. Hi everyone, my name's David Doss. I'm here with CKC Fund, which is a partner of Chain BLX, which brought Digital.Davos here. So thank you to Chain BLX and Digital.Davos for having me and for hosting this great event. I just wanted to speak briefly, so yeah, I guess I'll need to kind of condense things, but I wanted to just talk about the latest wave in the digital asset cryptocurrency industry in light of what's been going on over the last roughly 6 months or so in the space. So ultimately what we've been seeing at this point is a next wave in the digital asset space where the digital assets have been operating in roughly 4-year cycles, and what we see here is basically the buildup into the next cycle. So normally what we've been seeing with Bitcoin and with other digital assets over the last roughly 12 years has been a period where there's a buildup followed by a very I guess a partial drawback during this period known as the halving, which just happened, followed then by a significant bull run over the subsequent 6 to 12 month period. So what we're seeing at this point now is the Bitcoin ETF out in the market, something that has been drawing a lot of investor demand. But we're also seeing this as the next phase for the asset class. If you look at something like the gold ETF that came out, what happens when you get kind of the number one asset in a space into an ETF is that it tends to basically squeeze the price potential of that asset a little bit. So what happened with gold was that investors increasingly started turning more towards private markets in precious metals around stuff like silver, platinum, basically alternatives to gold when the ETF came out. That's something we're seeing now with the digital asset space, where now that there's a Bitcoin ETF, this is great for basically access to retail investors, but this also means that basically the smart money in the space is moving more into private markets and moving also more towards alternatives to Bitcoin. The 25,000 or so different altcoins, as they're called, basically cryptocurrencies and digital assets other than Bitcoin, are what people are turning to. So a couple of other notes about basically where things have been moving in the space is that a lot of people came into the digital asset space through kind of two different extremes. One was venture capital, early stage venture capital, and then the other one was more these kind of high frequency trading, ultra leveraged funds. And so what we saw with the venture capital was basically a lack of liquidity, where a lot of these investments are basically on 10 to 15-year time horizons. And that meant that essentially folks have not been able to really benefit from liquidity when they have entered into those parts of the market. What we saw on the other side around high frequency trading, ultra leveraged futures, this sort of stuff, was a lot of the failures, the kind of things that we've all read about in the media last year and the year before, where basically there was a lot of liquidity, but there was a lack of regulatory oversight, a lack of third-party audits, basically a lack of the type of framework that you would come to expect from investing into, let's say, stocks or bonds or real estate. So that's ultimately something that we're seeing in this next wave, is that institutional capital savvy investors are looking towards solutions that really mirror best practice, tried and true investment strategies from other asset classes. For example, thinking through, say, how you would manage a stock portfolio, most people, they don't just go in when they're investing into stocks and say, oh, what's the number one flavor of the day? Microsoft. Okay, put all the eggs into the Microsoft basket. What they'll do is they'll go through and maybe they'll work with a portfolio manager, and they will build out a well-diversified portfolio across high market cap stocks, mid caps, low caps. They'll also allocate into different use cases such as healthcare or financial services, technology, industrials. We're increasingly starting to see that same push in the digital asset space, where there are many, many different types of digital assets that each have potential for independent gains, they're independent use cases, independent fundamental value that they are providing. And so what we're seeing is an opportunity to basically build out those well-balanced portfolios, actively adjust them as the markets shift, and then basically help those investments evolve as the space evolves. The other thing that we're starting to see is that increasingly people want to be treated as a priority when they're going in and investing into these digital assets, where something like a big ETF is great, again, for the transparency, for the kind of the growth of the space in general. But we're seeing also that allocating capital into an ETF on top of basically the limits of the returns can also mean that an investor is just a drop in the bucket compared to other people in a gargantuan ETF. So what we're seeing is, in this emerging asset class is a desire for people to basically have a clear understanding, week in and week out, of what's going on with their investment portfolio, why they're seeing certain good or concerning behavior around specific assets. And so basically looking to have more of that relationship-driven approach to what they're doing. Beyond that, we're also seeing the value proposition for digital assets as a hedge against volatility in other markets. So something like a well-managed digital asset portfolio is something that will show low correlation to stocks, low correlation to bonds, real estate, oil, gold, etc. So the idea being that a well-balanced portfolio, when you see, say, your stocks or your real estate zig, you're seeing something like this zag and help balance things out. Also, what we're seeing in terms of investor demand and market demand overall around this is basically the value of an emerging asset class such as digital assets as basically the asymmetric upside potential, where, for example, surveys of high net worth individuals, modern portfolio theory analysis, analytics from Forbes or ARK Invest are showing that there's a preference to allocate somewhere between 2 and 10% of a portfolio into digital assets. The idea there being that when it is well managed, when the risk is mitigated, when there's insurance audits, all of those important things, that can really provide an asymmetric upside opportunity. So take, for example, if you had a $100 million portfolio, what we're seeing with a lot of high net worth individuals is a preference to allocate, say, something like $5 million into the digital asset space. At that point, if there's volatility in the space, a bit of ups and downs, there's still functionally a $100 million portfolio overall. But when the upside is maximized with the risk being managed, you're seeing that 5% position be something that can become, say, $20 million or similar, at which point the overall picture of the portfolio becomes a lot different. So these are just overall some of the factors that we're seeing in this new wave of the space, is basically a push towards more liquidity, a push towards more transparency, regulatory frameworks, towards the kind of common sense, disciplined, and analytical investment behavior that you would expect from any other asset class, applying that into a new space such as this digital asset space. Thank you, everyone, and on to the party.